I have just focused on Institute of Cost and Accountants of India material, because I know for sure entire paper is going to be crafted from that particular material. You also, as a CMA students, should focus on CMA Institute study material to as far as possible, to as much as possible in all the subjects which you are taking coaching of, all the subjects which you are not taking coaching of or doing self. Please focus on the Institute study material very well. I have in my entire book have focused particularly on Institute of Cost Accountants of India study material only, and I've taken some past examination questions, some more practice questions from the RTPs, MTPs, and I've focused exclusively on CMA final syllabus, because I know that entire examination is going to come from this particular study material only. Therefore, my book is inspired from the Institute study material, so you need not look at any other reference material, any other book for studying direct taxation. The book which has been supplied to you, the notes which have been supplied to you in my classes, they are more than sufficient. If you do those thrice, and if you just give me tests which are scheduled for you in the WhatsApp group. Oh, what are you saying? You're not in the WhatsApp group? Please call up my team at 9643929913 and add yourself in the WhatsApp group. Weekly tests are happening on direct taxation in that WhatsApp group. So just get yourself added in that WhatsApp group, and you will be privy to the test series, the discussions which we have on a normal basis, the assignments which I give for taxation on a regular basis. You will be privy to all those information through those WhatsApp groups. Before moving any further, let me tell you an interesting development which has happened in the world of double taxation avoidance agreements very recently. Very recently as in 3 years, 4 years back. Okay, so double taxation avoidance agreements are the agreements which are entered into between two countries for mutual discussion on how to avoid double taxation. But 4-5 years back, there has been an advent of another agreement which is known as MLI, multilateral instrument. Multilateral instrument is an instrument which deals with more than two countries who are sitting together to reach out to an understanding which will avoid double taxation. So where DTAA focuses on two countries, MLI focuses on multiple countries. So when multiple countries come together, sit on a table and decide on where would the taxing rights go, who would tax, what kind of income, whether resident rule will be applicable on this particular income or source rule will be applicable on this particular income, to decide all these things. When multiple countries come together, it is known as MLI. When two countries come together, it is known as double taxation avoidance agreement. So these are the agreements which are into existence for avoiding double taxation in any situation, in any international transaction. Now, sir, you've been using this word many times. Double taxation, double taxation, double taxation, double taxation, double taxation. Sir, what are the kinds of double taxation? How does double taxation happen? What are the sources of double taxation? So, I've already discussed one kind of double taxation with you, which is the juridical double taxation, which is the jurisdictional double taxation. I'll reiterate my example for benefit of all of you. Mr. Raju, owner of Sarvana Bhavan, having multiple outlets of Sarvana Bhavan in India as well as in US. Now the outlets which are there in India, of course, Indian government will collect revenue, will collect taxes on the profits which are earned by the Indian outlets. But who will collect the taxes on the outlets which are there in United States of America? Now, in absence of any double taxation avoidance agreement, there will be double taxation, because these branches, Indian government will say, because Mr. Raju is resident in India, therefore these branches will be taxable in India. Indian government will say like this, and United States of America government will say, since the income is sourced from United States of America, so Mr. Raju, please pay the taxation in United States of America. So there will be double taxation of Mr. Raju owing to a single transaction, owing to a single income. Same transaction is being taxed twice in two different countries. This is known as jurisdictional double taxation. Same income is being taxed, same taxpayer is being taxed. Same income is being taxed. What is the income? PGBP from New York branch, PGBP from New Jersey branch, PGBP from California branch. Same income is being taxed twice and in the hands of same taxpayer. Who's the same taxpayer in our case? Mr. Raju. Mr. Raju is paying taxation on same income in two countries. This is known as juridical double taxation, also known as jurisdictional double taxation. Juridical double taxation or jurisdictional double taxation. Treaty will focus on this type of double taxation more. Then second kind of double taxation, which is again prevalent in the country, is economic double taxation. Now, so what is economic double taxation? I'll give you an example. Okay, so economic double taxation means, I have to rub the board to explain you economic double taxation. I need some space. Okay. Okay. Now, economic double taxation means, this is India, this is United States of America. Okay. Okay. So in India, there is a company X, company limited. Its shares are held by Mr. Rolf. Shares of X company limited is held by Mr. Rolf. Mr. Rolf is a resident of United States of America. He's never been to India. He's always been in United States of America. Now, X company declares dividend to Mr. Rolf. Now, suppose there is a law in the Indian country that on dividend, the company is required to pay tax and the dividend will be exempt in hands of the shareholder. Suppose, I'm giving an example. You know, law has changed in the current year, law has changed. This is no more the law in India, but I'm giving an example. It's an hypothetical example. Suppose in India, there's a law that on dividends, company is required to deduct tax at source, which will be in the form of DDT, dividend distribution tax, and the dividend will be exempt in hands of shareholders. Of course, the law cannot state that we will tax dividend in hands of company as well as in the hands of shareholder. Law cannot state that. So in India, there is a law that company will pay taxes on the dividend and the shareholder will be exempt from paying any tax from dividend. However, in the United States of America, the law is that in hands of company, the dividend is exempt, but in hands of the shareholder, the dividend is taxable. Reverse law is there in United States of America. Now what will happen? On the dividend which is distributed by X company to Mr. Rolf, first time taxation will happen in the hands of in the hands of X company according to Indian laws. The Indian company will be required to pay dividend distribution tax on the dividend distribution to Mr. Rolf. On the second hand, again taxation will happen in hands of Mr. Rolf on the same income. What is the same income? Or a dividend income, the same income. X company is paying taxes by way of DDT, dividend distribution tax, and Mr. Rolf is paying taxation through dividend. He is paying taxation on dividend. So Mr. Rolf is paying taxation on dividend. X company is paying taxation in the form of DDT. Therefore, there will be double taxation on the same source of income. In this situation, dividend is being taxed in hands of shareholder in the United States of America. The dividend is being taxed in hands of company in India. This is known as economic double taxation. Please read. Same income. Yes, dividend income. Different taxpayers are paying tax on the same income. That is how economic double taxation works. So, juridical double taxation, same income, same taxpayer. Mr. Raju earning income of PGBP from New Jersey branch. Same income, same taxpayer paying income tax in India, also paying income tax in US. Economic double taxation, same income is same, but there are different taxpayers who are paying tax on the same income. Dividend income, first taxable in hands of X company, secondly taxable in hands of Rolf. So same income, double taxpayer. Treaties do not generally deal with economic double taxation. Treaties are more likely to deal with juridical double taxation. Treaties do not deal with economic double taxation in a very proper manner, in a very detailed manner. Yes, that is how treaties are not addressing economic double taxation. Treaties are primarily addressing juridical double taxation only. So these are two types of double taxation which are existing in our tax treaties, which are existing in our double taxation avoidance agreement. Now, let us move on to our two basic concepts of international taxation. Then we'll be moving upon on our theoretical portion from our book, The two topics which we are going to study now are tax havens. Topic number 1, tax havens. Topic number 2, CFC. CFC, Controlled Foreign Corporation. So let's talk about tax haven. Okay. You must have heard the name of Mauritius, the name of Bermuda Triangle, the name of British Virgin Islands. So these are certain territories where tax rate is very, very low. Why is tax rate low in these particular countries? Do they don't want tax? Do they don't want to collect tax? Do they don't want their infrastructure to grow? Do they don't want their country to grow? Now the reason why they don't collect taxes quite often is that they want taxpayers to get attracted to them. How would taxpayers be attracted to them? A country where there is no taxation or very less taxation, naturally companies will be lured to establish their business organization in those countries. So for example, I want to establish an organization in a country which is outside India. If I want to establish an organization which is in a country outside India, then obviously I will look for a jurisdiction which is low tax jurisdiction, where taxation rates are very low, where taxation rates are nominal, so that I need not pay tax. So I will choose British Virgin Islands, I will choose Mauritius, I will choose Bermuda Triangle, I will choose Singapore. All these countries are tax havens. Sir, but why are they levying low taxes? I'll tell you the history. So I'll tell you history of a very popular state known as Singapore. Singapore is basically an island which is covered by ocean on most of its sides. It is covered by ocean. It does not have any natural resources. Does not have any natural resources which it can sell and it can earn revenue for its country. It does not have any grains, any wheat, any paddy. It cannot grow vegetable because its land is not fertile enough. Because the states which are close to water, which are close to ocean, their land is not fertile enough. Their weather conditions are not susceptible to agriculture. They cannot grow food. They cannot have dairies. They cannot have farms. They cannot have natural resources. They don't have natural resources. So they barely have any source of income. When they barely have any source of income, how would they earn revenue? How would they dare develop infrastructure for themselves? How would they develop resources for themselves? It's a big problem for such countries who are, especially the islands who are covered by water from all sides. It's a big problem for them. They have no source of revenue. They have no resources. They have no income generating capacity. Now, they have discovered a unique way to develop revenue for them, a unique way to earn revenue for them. What do? They attract multinationals to establish their subsidiaries in that country. So if multinational from say India would come to Singapore, it will face very less tax, very less tax, or even no tax. There's no tax in these countries. So they will attract foreign investment. They will ask Indian businessmen. So they will ask Mukesh Bhai Ambani. They will ask Raju, who's owner of Sarvana Bhavan. He will ask all these businessmen to establish their businesses in Singapore. They will ask their owners to establish their factories in Singapore. Because the labor is cheap, taxes are zero, the natural resources which are scarce, they will require the companies to bring their natural resources from themselves, from their home countries. They can ask the owners to bring their resources from their own countries. Infrastructure will be developed in Singapore. So naturally, if Reliance comes to any part of Singapore, then definitely Reliance will develop roads. Reliance will develop the infrastructure surrounding their factory because they don't need to work. This is how Singapore will attract many businessmen, many businessmen. So why would businessman go? Businessman will go because of zero tax. 30% tax is a very big amount. There's a huge saving which businessman is seeing. They will go to Singapore, establish their factories in Singapore and earn profits and not pay any taxes. This is the benefit which an Indian businessman will have, or any US businessman will have, or any Australian businessman will have. So they will relocate their factories, they will relocate their businesses, they will relocate their branches to a tax haven like Mauritius, like Singapore, like any other parts of the world. Switzerland is one of them. Switzerland, you've heard that, you know, there are Swiss accounts which are belonging to Indian politicians which are located in Switzerland, and they have crores and crores of rupee, but Switzerland government is reluctant in sharing any information to Indian government. Of course they cannot share, because if those huge amount of money is discovered by Indian government will snatch that away from Switzerland government, and Switzerland economy will go for a toss, because Switzerland economy is working on those deposits which are made by Indians in Switzerland. So to develop the infrastructure, to develop the economy, to grow their resources, such countries have become tax havens. They have chosen to give a discount on tax. See, tax is 30%. The benefit which these countries are earning is the natural resources, the infrastructure, the money which the businessman will bring with itself. It will grow the domestic country. It will give employment to the people who are staying in Singapore. It will give employment which is scarce in today's world. There's no employment for Singapore people. The companies which are coming to Singapore, they will give employment to Singapore people. They will give revenue to Singapore people. Singapore will become rich. Singapore will become abundantly resourceful, and it will become an economically self-sufficient country. And this is exactly what happened to Singapore. Singapore, 30 years back, came up with lucrative tax sops for countries, for companies, and therefore Singapore is fully developed country today, owing to the money which has been received from the foreign world, the foreign countries. These are known as tax havens. Tax havens will give you fruitful and lucrative tax benefits. Because of those tax benefits, businesses will shift their branch offices, their factories to those countries, and those countries will have profits, and those profits are tax free. If the same profit is being earned in India, then definitely it will be subject to huge taxes. Yes, some additional cost will be levied, will be incurred by the businessman for relocating the factory to that particular country. Singapore, obviously, some cost will be incurred, but that cost is nothing as compared to the benefit which, from the perspective of tax, will be accruing to that particular businessman. The benefits are huge. These are known as tax havens. Now, if these countries, if these businessmen go out of India, then who's that one person which is losing its revenue? It is the Indian government. Indian government will say, wow, you are resident of India, but you are establishing your factory outside India, and just because of source rule, you are not required to pay taxes in India. Absolutely. That is the basic concept. In the treaty between India and Singapore, the treaty will say that the PGBP income will be taxed on source-based rule. Therefore, it will be taxed only in Singapore. India will not be eligible to tax the profits which are accruing in Singapore of an Indian resident. Indian government will not be eligible for those taxes. Yes, this will happen. And this is how it happens. And this is why tax havens are very, very popular. So yes, now what is the alternative? Now Indian government is, feeling that I'm being cheated. Indian government is feeling that ways. So now what will Indian government do? Indian government will amend the DTA. Indian government will amend the DTA between Singapore and India, and it will say that only if the control and management of the company is outside India, which is in Singapore, only then Singapore gets the right to tax that particular profit. If the management and control of that particular company is in India, then India gets the right to tax that particular profit. Some sort of this sort of clause will be inserted by the Indian government in the treaty between India and Singapore to stop this loss which is incurring to government of India. 3-4 years back, Mauritian treaty has undergone an amendment. In Mauritian treaty, the capital gain tax was the right to tax capital gain was given to Mauritius, and Mauritius is a zero tax country. Therefore, the treaty was amended and the right to tax capital gains was taken back to India. India said that, okay, no, we want capital gain tax right because you are a zero capital gain tax country. So even our citizens are lured to earn capital gain in your country rather than our country, because you will not levy tax on the capital gains which are happening in your country. I'll give you a very small example, okay, very small example. Let's look at one example of this capital gains, and it will be really interesting to you to understand this concept in a very, very easy manner. Okay, okay, sir. Okay, so this is United States of America, this is India. India has a company called X Limited. Okay, shares of X Limited are held by a US resident, Mr. Joseph. Mr. Joseph holds the shares of X Limited. Now what Mr. Joseph is doing, Mr. Joseph is actually Mr. Joseph had purchased these shares some 5-6 years back of X Limited. In India, he invested in X Limited. He purchased these shares 5-6 years back, and this company was a amazingly growing company. Therefore, the share price grew by 5 times or 6 times. Now, Mr. Joseph wants to sell its shares of X Limited. It wants to sell the shares of X Limited. Now, US government is saying that obviously since you are resident of India, a resident of USA, you should pay tax in USA. Tax in USA is say 20%. Indian government is saying no, you are a resident of India, you are the source of income is in India, so you should pay tax in India. Suppose in India the tax rate is 25%. The tax rate of capital gain is in US is 20%. Tax gain of capital in India is 25%. So capital gain 25%, capital gain 20%. What would Joseph prefer? What would Joseph prefer? Of course, 20%. 20% is lower than 25%. Joseph would prefer 20%. Joseph would say, okay, I would like to, I would like to pay tax at the rate of 20%. Naturally. Now, I'll give you another example. Now, look at this example very, very carefully, because in this particular example, I'm going to restructure this transaction in a way to reduce my taxes to 0 from 20%. In the current transaction, Mr. Joseph is required to pay tax at the rate of 20%. Suppose DTA also says this, that according to DTA, Double Taxation Avoidance Agreement, the resident rule is applicable. Whosoever is the resident of that particular country, the resident is eligible. The country in which that particular person is resident is eligible to charge taxes. So Mr. Joseph has to pay taxes at 20% to US government, not to Indian government. Now, let's restructure this transaction in a way to reduce our tax burden to 0. I will reduce the tax burden to 0. 0. Yes, let's see how. United States of America. Mr. Joseph. In India, there is a company called X Limited. Mr. Joseph wants to buy shares of X Limited. 5-6 years back, he wanted to buy it. Now he wants to sell. Now, while he bought the shares 5-6 years back of X Limited, what he did was he invested money in a Mauritian country. He created a company in Mauritius, a fake company. He created a company in Mauritius. Joseph invested money in Mauritius, and Mauritian company invested money in X Limited. This is known as a step subsidiary. So Joseph invested money in Mauritian company. Mauritian company invested money in X Limited. This is the transaction. Now, what happened was, Mr. Joseph, after 5 years, when the value of X Limited shares has grown 5-6 times, he wants to sell off shares of X Limited. So what Mr. Joseph does is, Mr. Joseph, who holds the shares of Mauritian company, sells these shares, which is held by Mauritian company. It is indirectly held by Joseph. Indirectly held by Joseph, but directly held by Mauritian company. So Mr. Joseph sold these shares of X Limited to whomsoever, earning a capital gain. Right? Now capital gain is being earned by whom? Joseph or Mauritian company? Mauritian company. But you and me know for sure Mauritian company is fake. Mauritian company is just a shell. The real owner of Mauritian company is Mr. Joseph only. We know that fact. But on papers, what is it said? On papers, Mauritian company is the person who's earning capital gain. Is Mr. Joseph earning capital gain? No. Is US government involved? No. Which government is involved? Mauritian government is involved. Mauritian government is involved. Mauritius is selling shares. Mauritian company is selling shares of X Limited. Mr. Joseph is not selling shares of X Limited because Mr. Joseph do not hold shares of X Limited. How can Mr. Joseph sell shares of X Limited when he doesn't hold shares of X Limited? So who's holding shares of X Limited? Mauritian company is holding shares of X Limited. So Mauritian company is selling shares at a capital gain. Now, since Mauritius is a tax haven, capital gain in Mauritius is taxed at 0%. Capital gain in India is taxed at 25%. Double taxation avoidance agreement says that the resident rule is applicable for taxing capital gain. Who is the revenue earner? Mauritian company. This we know that Mauritian company is just a shell company. It's not substance. It's not a substantive company. Mr. Joseph is the indirect holder, but on papers, what is it? Mauritian company is the real company. Now, who is the person earning capital gains? Mauritian company. Where is Mauritian company resident in? Singapore. What is the tax rate of Singapore? 0%. How much tax rate will be paid on this Singapore? 0%. India is not liable to pay taxes. India is not liable to charge taxes. Mauritian company is required to charge taxes, and Mauritian company is charging tax at the rate of 0%. Whatever capital gain Mauritian company will earn, it will send it to Mr. Joseph as dividends or as any other cash repatriation technique. And Mr. Joseph earned capital gains without paying even a single penny of tax. How does this entire transaction work? Because of presence of a tax haven in between. This is how. If you structure your transaction in a smart way, in an intelligent way, you can avoid payment of taxes through tax havens. If you have multiple layers of companies in between, one of the layer is belonging to a tax haven country, then definitely you are going to save a lot of taxes. This is an unethical way of saving taxes. Undoubtedly, it is as per law. You are, following law, but in essence, you are doing something unethical. Because everyone knows that this is a shell company. This doesn't have any substance. It doesn't have any substance. And a country which does not have any substance, a company which does not have any substance, should that company be allowed to hold shares or to earn capital gains and to claim that I'm not earning any capital gain tax, I'm not paying any capital gain tax? Answer is no. But so be it. You're using a tax haven to save the entire profits, entire taxes. If you were in a linear or a lean transaction, the real transaction, if you would have in this situation, you would have required to pay 20% tax. Since you introduce Mauritian company in between, you are required to pay 0% tax in Mauritius on capital gains. This is the benefit of tax havens. And what is the benefit of tax? This is the benefit of tax haven to the taxpayer. What is the benefit of a tax haven? The benefit is Mr. Joseph is creating a company, introducing money in that company. That company is introducing money to India. So indirectly, Mauritian government is getting hold of certain reserves. Those reserves are definitely directed to India, but then dividends will come up to Mauritian company, and then Mauritian company will have those dividend reserves as well. So economic activity in a particular country will be flourished by these transactions. The tax haven will have economic introduction of economic activities. That is the benefit which tax havens earn. Yes, tax havens are at a loss because they are not earning any tax, but they are okay with that loss. They say, okay, I'm okay with that loss. Till the time I'm earning resources, till the time people are investing in my country, I'm okay with bearing loss of tax. I don't want to earn any tax. So this is the planning which tax haven facilitate. So what are the features of tax haven? No or nominal tax. There is no tax, there is nominal tax. Secondly, lack of transparency. So the tax laws which are there in tax havens, they are not transparent. So they might have different tax laws for their residents. They might have different tax laws for non-residents. They might have different treaty benefits for different people who are residing in different countries. There is a lack of transparency in their laws. Their laws are not clear. They're not concise. They're biased. They have biased laws. Because if they are earning more profit from a particular country, they will offer more tax benefits to them. If they are earning less profit from a particular company, they'll offer less tax to them. This is how they distinguish. This is how they create partiality. Next, no local presence. So this is the worst part of tax haven. There is no local presence which is required. This Mauritian company, this company is just a shell company. There's nothing in that company. There's just a room which is taken on hire, and that room states the name of the company. That's it. There is no substance in that particular company. Mr. Joseph has not visited Mauritius ever in his lifetime. Mr. Joseph has never visited Mauritius. There was a lawyer in Mauritius. Through that lawyer, Mr. Joseph created this shell entity, this fake entity. So no local presence is required. So person who's earning profit, Mr. Joseph is earning profit from Singapore, but Mr. Joseph is not required to be present at Singapore. Wow. Without even being present at that particular place, you are earning profit from that particular place. This is the irony of tax havens. There's no local presence required. There's no substance required. You can work on papers in tax havens. No requirement of any local presence. Substance requirement is not there. They are just a facade. They are a fake. They are shell companies which are there in these tax havens. And then last, no exchange of information. So generally these countries are reluctant to share information with other governments. So if Government of India through X Limited, if it approaches the Mauritian government and asks the Mauritian government, hey Mauritian government, can you please give me details of this Mauritian company? Where is it located? How many employees does it have? What is the work which is doing in its premises? Mauritian government will say, no, I'm not going to share this information to you. This is private information of my client, Mr. Joseph. In reality, it's not the private information. But they know if they disclose this information, then the Indian government is going to treat this particular entity as nil, as nothing. And they are going to tax Mr. Joseph as if this transaction was happening between India and Mr. Joseph. They will treat this entity as transparent entity. They will forget about this entity. Indian government will say, Mr. Joseph, you should pay tax in US. You are the real owner of Mauritian company. Mauritian company is a facade. It's a transparent company. So you should pay taxes in US. This is what Indian government will say if they come to know that Mauritian company is a fake company. But Mauritian government is never going to share information about this fake Mauritian company to Indian government. Even if Indian government is pressurizing Mauritian government is not going to give any information. So there is no exchange of information. Information is not exchanged with tax havens to other countries. Information exchange is a reluctance. The basic point of reluctance is that they don't want to share information. Mr. Joseph, US, India, all these countries will be asking for information from Mauritian company. Mauritian country will not share the information. This is the fourth and one of the most important features of a tax haven. So this is the concept of tax haven. Yes, a legal concept, but an unethical concept. And to curb this malpractices of tax havens, there are many things which are planned by world forums. World governments are coming together to curb these malpractices which are done by tax havens. And in the years to come, we will see some concrete steps being taken by governments of all the countries to curb the malpractices which are being done by tax haven. One of the recent steps which the Indian government has taken is that it has amended the Mauritian Treaty. Now, according to Mauritian treaty, earlier the capital gain was to be taxed at the resident level. So Mauritius company was required to pay taxes. Now, as per the amended Mauritian treaty, Indian government can also collect the gain which is accruing to resident of Singapore. Now, even if you have this fake entity in between, tax is not going to be spared. Either you pay tax in India at 25%, or you pay tax in Mauritius at 0%. So the option will not be given. Option will not be given to you. Indian government will definitely ask you for taxes in India at 25%. Indian government will levy taxes at 25%. Right to tax is snatched away by Indian government. So after the amendment of Mauritian Treaty, this menace, this benefit which Mauritian countries used to take is now out of question. Now they cannot take this benefit. So yes, this was the entire concept of tax haven. Now let's move on to the concept of controlled foreign corporations. So the last topic which we are going to start today is controlled foreign corporations. In short, they are known as CFCs. This is again a misuse of international transaction. This was the first way of misusing international taxation. This is the second way of misusing international taxation. Now, what is misuse of international taxation? Misuse of international taxation means taking benefit of a lower tax jurisdiction to lower your taxes. Deliberately scheduling your manufacturing setup in such a way that your direct taxation is reduced. Deliberately structuring your transaction in a way that the direct taxation is reduced. This is the loss of international taxation, and due to different tax rates in different countries, many companies do this kind of nuisance. What is controlled foreign corporation? Okay, so there's a company which is X Limited. This company is located in India, of course, one of the highest tax paying countries of the world. The tax slab rate, the slab rates of tax are highest in India. Now, X Limited established its 100% subsidiary in UAE. Name of the 100% subsidiary is Y Limited. Now, there is some passive income. What do you mean by passive income? Passive income means some interest which is being earned by X Limited. So suppose X Limited wants to buy some debentures of a foreign company. There's a foreign company in United States of America, and X Limited wants to buy debentures of this company. Why? Because X company feels that their passive income, which is interest, passive income means incomes which doesn't require a lot of effort to earn that income. Interest, rent is a passive income, royalty is a passive income. So X Limited wants to invest in the United States of America some money by way of debentures. Okay, so rather than directly investing in United States of America, X Limited establishes a subsidiary in Y Limited as Y Limited in UAE, and this company invests in USA, in debentures of USA. Interest is earned by this company. Y Limited earns interest from which company? From the USA company. Y Limited earns interest from which company? The USA company. Ideally, Y Limited should remit the earning to X Limited in forms of dividend. Now, interest income, since UAE is a low tax jurisdiction, UAE is United Arab Emirates. So UAE is a low tax jurisdiction. So interest income will be taxed at a very, very nominal rate. But when dividends will be declared from Y Limited to X Limited, that will be charged at the tax rates which are prevalent in India. This will be taxed at a higher tax rate, this dividend. So ultimately, whether X Limited would have earned interest directly from US, or now if it had routed its transaction through UAE, there is no tax benefit which is accruing to X Limited. Because when Y Limited pays dividend to X Limited, then dividend is taxable at a very high rate in India. So no benefit which has been accrued to Indian company. So now, what will Indian company do to gain some benefit? Indian company will not invite any dividends from Y Limited to X Limited. X Limited will say, listen Y Limited, you are my subsidiary. You and me are the one and the same thing. Money kept with you is equivalent to money kept with me. So do not declare any dividend. Whatever interest you are earning from United States of America, keep it reserved with you. Whenever the right time comes, I will ask you to invest this money elsewhere. Elsewhere means maybe invest this money in a subsidiary which I am going to establish in Australia. If I would need money in any part of the world, I will ask you to invest that money in that part of the world. But please don't declare dividends to me. Because the moment you declare dividends to me, Indian government will charge tax on that dividend. So this is a way in which taxes are either deferred or they are not paid at all by a subsidiary of a Indian company in foreign. This is known as controlled foreign corporation. A foreign corporation, which is in our case Y Limited, is controlled by the Indian company, and it is controlled in a way that Indian company is forcing the subsidiary to not to declare dividends to its parent company, thereby deferring the taxes or paying no taxes or gaining tax benefit. This is known as controlled foreign corporation. So what is the loss to Indian government? Loss to Indian government is that Indian government deserved income tax on this particular income. Either this income or the income which Y Limited would have disbursed to X Limited. Indian government deserved that income tax. But Indian government is devoid of that income tax. Since Indian government is devoid of that income tax, Indian government is going to look at this transaction in a very, very critical way. You know what Indian government is going to say? Indian government is going to tell Y Limited, okay Y Limited, you are not declaring dividend. Fair enough, don't declare dividend. Even if you are not declaring dividend, we will assume that if Y Limited has cash reserves, if Y Limited has reserves, if Y Limited has profits, we will assume that dividends have been declared to X Limited the moment earning is earned by Y Limited. We will assume that dividends have been declared. Deemed dividend will apply. So this assumption that dividends have been earned by X Limited, despite of the fact they have not been declared, they have not been repatriated. This is the provisions of controlled foreign corporations. As of now, Indian government has no such law in Indian context. These laws are there, CFC related laws are there in the United States of America and several other parts of the world, but India does not have any such law. India does not deem dividend without declaration, without distribution of dividends. So as of now, no law, but just to introduce you to the nuisance value of international transaction. International taxation has nuisance value. Just to introduce the malpractices which are undertaken by the companies to avoid taxation, we have introduced these two topics with all of you. See, in domestic taxation, we already know what are the loopholes, what are the bad things which a person can do to avoid taxation. We already know that. You know, increase of expenditure, showing reduced revenue, not disallowing the disallowances. So if there's a disallowance for TDS not deducted, you are not disallowing that. That kind of tax benefits are there. That kind of tax leakages are there in domestic taxation. Now, what kind of tax leakages are there in international taxation? These are the two examples of leakages which are there in international taxation. So these are the broad concepts of international taxation which we have covered today. Just to give you a hint of how international taxation works, how does it look like? What is the difference between resident rule and source rule? What are the two forms of double taxation? What is double taxation avoidance agreement? What is MLI, multilateral instrument? And finally, what are the nuisances which are there in international taxation? We have covered a fair bit of international taxation today. And in the next session, we are going to start with the theoretical portion in the book. We are going to read certain aspects of international taxation, and then we are going to further delve into and explore international taxation further. As of now, your homework, see this video lecture once again and read through the theory text which is given in the notes which I have supplied to you, my book which has been created exclusively from the Institute of Cost Accountants of India material. Now, this is a very, very important step, guys. I have just focused on Institute of Cost and Accountants of India material because I know for sure entire paper is going to be crafted from that particular material. You also as a CMA students should focus on CMA Institute study material to as far as possible, to as much as possible in all the subjects which you are taking coaching of, all the subjects which you are not taking coaching of or doing self. Please focus on the Institute study material very well. I have in my entire book have focused particularly on Institute of Cost Accountants of India study material only, and I've taken some past examination questions, some more practice questions from the RTPs, MTPs, and I've focused exclusively on CMA final syllabus because I know that entire examination is going to come from this particular study material only. Therefore, my book is inspired from the Institute study material. So you need not look at any other reference material, any other book for studying direct taxation. The book which has been supplied to you, the notes which have been supplied to you in my classes, they are more than sufficient. If you do those thrice, and if you just give me tests which are scheduled for you in the WhatsApp group. Oh, what are you saying? You're not in the WhatsApp group? Please call up my team at 9643929913 and add yourself in the WhatsApp group. Weekly tests are happening on direct taxation in that WhatsApp group. So just get yourself added in that WhatsApp group, and you will be privy to the test series, the discussions which we have on a normal basis, the assignments which I give for taxation on a regular basis. You will be privy to all those information through those WhatsApp groups. So yes, please study these topics very well. Just have understanding theoretically also of these topics. We'll be meeting in our next session with more such fun topics of international taxation. Till that time, all the very best and happy studying.